And we go straight to London now, where the markets are mid-session. And I'm joined by Nick Parsons, who's Head of Research at National Australia Bank in London. Now, Nick Parsons, London seems to be going the way of our markets all over the place.
Oh, it's a wild and volatile ride here in London, Tiggy. We've been down 200 points. We've been back to flat as we speak now. We're down 100, and Wall Street's open is only 15 minutes away. It's been massively volatile.
And what are the Dow Jones doing, the futures?
Well, at the moment, it's indicated to open around 120 points higher. But bear in mind that just during the London session, it's been between minus 250 and plus 260. So after yesterday's very, very weak close, we've been in a 500-point trading range in the 7 hours that I've been here. Absolutely wild.
Now, are these volatility levels anywhere near the sort of levels that we had when we had the Lehman crisis?
You know, they're approaching those kinds of levels. When a market moves 5 or 6 percentage points a day, then we're getting to extremes of volatility. I've been doing this job far too long. I've been doing it over 25 years, and I can only think back to about a dozen days in that entire 25-year period when we've had 5 and 6% daily swings. So it's certainly up there.
Now, how much is this volatility, this uncertainty about a basic market distrust of whether the policymakers in Europe, let's stay with Europe for the moment, in Europe can actually fix this problem?
Well, there are real concerns in Europe that the ultimate fix for the problem, which is to say that Germany needs to underwrite Italian and Spanish debt, will simply not be acceptable to the German people. So we know what the fix is. The problem is that those who are in the position to actually provide the fix simply don't want to do so. Germany wants to keep the euro together, but doesn't want to take on any of the obligations that go with it. And that, for investors, as for everyone else can see, is a simply untenable position.
And yet there's a general agreement that the ECB needs a much bigger bailout fund.
Well, the ECB has actually been very, very active in the markets over the course of the last few days. It's rewarded Italy for the balanced budget proposals it put forward last Friday. But the ECB can't do it all on its own because the ECB itself is putting its own capital at risk. There is no easy solution for these problems in Europe. And as investors are realising that against a background of slow or even zero growth, it's really, I think, to be expected that this volatility can continue for some time.
Now, over to the Atlantic, and the US Federal Reserve meets tonight, our time. Now, nothing usually happens at their August meeting because they usually do everything at Jackson Hole, but they've got this expectation now, the market expectation, that something will indeed happen, some sort of stimulus.
Yeah, and I think that lays the ground for grave disappointment this evening. It's only a one-day meeting, so we've got no press conference. We just get a regular statement. And I think market hopes are far too high as far as this evening's statement goes. I'm sure there'll be a declaration that they stand ready to provide support as required. But when you pick the statement apart for hard measures and detailed evidence of what that means, I think we're going to find it wanting. And I fear that after the statement is released, that we're in for another move to the downside this evening.
Nick Parsons, thank you very much for joining us tonight.
You're welcome.